Market performance year to date has been much more volatile than expected due to a number of concerns, whether it's faster rate hikes, higher inflation. We've had new variants of COVID-19, as well as the Russia-Ukraine conflict. It's been a very risk-off environment where equity market performance year to date across the globe is all down. The particularly harder parts of the market, the Nasdaq Composites down over 30%. The Russell 2000 small cap index is over 20%. S&P 500 now is in bear market territory over 20%. You've also seen a similar weak performance across global bond markets as well, with the Barclays Global Aggregate Index down over 15%. Another way to look at the market is really looking at the Russell US indices by market cap and style. And year to date, you've also seen declines in the growth indices in particular, where the Russell 1000 growth index is down over 30%, Russell mid cap down over 32.5%, and the Russell 2000, the small cap index down over 30%. The core indices have held in better, and obviously the value parts of the market have been a bit more defensive, but they are still down double digits, whether it's large cap value down over 12.5% to Russell 2000 small cap down over 15%. And so similarly, the concerns over inflation, rates, geopolitical conflicts, and COVID have also impacted the growthier parts of the market, particularly as the rate environment has gotten much higher in recent months. Looking at the S&P 500 returns versus the 10-year Treasury, we have seen obviously the expectations for the 10-year U.S. Treasury estimates really increase modestly higher over the last several months as faster rate hikes are now being priced into the market. And so, we kind of entered 2022 with about a 1.5% on the 10-year. There was expectations it would get to call it 2.5 expectation in the treasuries, really getting back up to 3 to 3.25 over the next kind of 12 to 18 months. And a lot of the contraction in the market has really been on multiple compression driven by this higher rate environment. On the right side, what you're going to see is really the S&P 500 index, the next 12-month EPS growth, and the next 12-month PE. And what you've seen is the next 12-month EPS growth has been, relatively healthy. We've seen over a compounded 35% plus earnings growth over the last 2 years. But we have seen a divergent with the S&P 500 performance now starting to diverge from the earnings growth line. You've seen the S&P PE multiple really contract from 21.5 times December 2021 to now around 15.7 times currently. So we've seen about a 27% contraction in the PE year to date, and it's down about 33% from the highs back in September of 2020. So a lot of the contraction in the market has really been PE multiples coming in as the higher discount rates from the 10-year get priced into the market. Looking at the most recent market declines and the recovery from that, we have seen some pretty healthy recoveries following these sharp declines, and long-term investors may have benefited if they can withstand this volatility. During the most recent drawdown, the S&P 500 is now down over 22% year to date. If you looked at the past several declines over the last 20 years, the COVID-19 decline in the S&P was around 34%. The global financial crisis was down 57%, and the dot-com bubble was down 49%. On the right side, looking at the Nasdaq Composite, the drawdown has been a bit steeper, down over 33%, compared to down 30% for COVID-19, 56% for the global financial crisis, and obviously the dot-com bubble was a bit more severe, down 78%. So we do think we are in the later stages of this correction. We do think market volatility will remain high, but as we continue to progress through the year, we're hopeful that we'll begin to see signs that the inflationary pressures are starting to moderate. Obviously, the Fed's aggressive moves with 75 basis points try to get back to the neutral rate of, call it 2.25 to 2.5 pretty quickly. And we do think that will start to moderate economic growth and start to relieve some of those inflationary pressures. So, we really do need a bit more time, I think, for the market to digest all these moving parts. To the extent we get some clarity on the Russia-Ukraine conflict, some of the gas and oil prices come in, I do think that those will all be tailwinds as we kind of progress through the year, as we start to slow the economic growth and the overheated economy.
So the market environment is probably one of the most dynamic environment that we've seen over the last 2 years. We're still dealing with the ongoing festering of COVID around the globe, and certain areas have had pockets or periods of lockdown, such as what's going on in China. And all these things have impact with respect to the economic backdrop from the perspective of near-term dynamics from supply chain initiatives, as well as long-term implication in terms of the pace of the recovery. And on top of all of that, trying to reopen the economy globally, we're clearly seeing inflationary pressures and also a lot of inefficiencies all over around a lot of different industries. And some of these inflation pressures is starting to broaden out. Initially, it was only relegated to certain materials and also transportation, but it now is festered into things like energy prices, material prices, wages. And so all these things have impact to global economy in terms of the sustainability of growth, as well as the impact of inflationary pressures. Investors are still going to be very leery and not focus on the fundamentals of the various companies. But once we get through the month of September, I think the expectations is that the Fed's policy will start to gradually taper because the rate increases, and therefore investors themselves will start to focus more on the fundamental drivers in the companies, or in other words, the earnings of the companies. We talk about the AI has the potential to disrupt every industry, and it's dominated by the first category is AI infrastructure, the second category is AI applications, and then the final category is AI-enabled industries. This is an area that has grown over the years because we're seeing much more diversification, meaning that companies offering unique aspects of their strategy, of their business, where they're adopting AI and how they're able to differentiate themselves and to deliver unique growth aspect when compared to that of their competition. AI-enabled industry cuts across every single sector that you can possibly, or industry that you can possibly imagine, from advertising, agriculture, manufacturing, automotive, etc. So it's the whole gamut in terms of where all the rest of the market, how they're adopting AI, how they're going to use AI to differentiate, develop new products and services to engage the market, use AI to be more competitive. This is really the unique aspect of this strategy. What AI infrastructure really is are the building block technology. So this is dominated by a lot of semiconductor companies as well as foundational software companies. And these are the companies that provide the basic ingredients to allow companies to adopt or build products or build services to allow companies to harness the capabilities of artificial intelligence. In AI applications, a little higher level up, now this is dominated a lot by software companies and obviously some of the service providers that utilize AI in their offerings, the likes of some of the social media companies. And all these companies are in different phases of adoption of AI and how they ultimately will have a lot of transformative impact in terms of not only themselves, but also to their respective industries as well. We are very optimistic longer term in terms of all the different categories that we have identified, such as AI infrastructure, where opportunities in 5G infrastructure build out, cloud computing, edge computing, etc. These are all very exciting opportunities for all the different companies that we identified to participate in the growth of which to enable the build out of AI infrastructure. Likewise, in the areas of AI applications, a whole host of software companies as well as service providers that live in that space that they can benefit from higher levels of growth as AI continues to proliferate out in the global economy. We're still at the beginning of this AI revolution. Today, we're only at the, people call it machine learning, where we're training the computer systems to do a single task. So the evolution of AI is still in front of us in terms of the longer term opportunity. And so there's still a lot of runway ahead of us in terms of where the strategy can go. Over the next 20 years or so, and 20, 30 years, the machines themselves will become much more robust and do multitasking, be more human-like, but that is still way out in the future, and there's still a lot of innovation to be had, and as well as development or maturing of the technology for a lot of different companies across all the different industry to harness. AI is probably going to be one of the most profound technologies that's going to transform all the different industries in the marketplace over the next 20, 30 years.
Allianz投資